Hello, and welcome to the next installment of Diversified's Asset Class and Manager Spotlight. My name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. Today, we're going to spend a little bit of time talking about one of my favorite topics personally. It's common pitfalls of investing. Now, there's dozens of these topics that we can go through in terms of what are mistakes that investors make. But there are a few that I really want to highlight. I want to spend a few minutes on because I think it's important as investors, whether you're a professional or just a investor on the side, something for, as a hobby or something for your retirement, to understand and have the self-awareness to really think through what are potential pitfalls that I may have, what are potential biases that I may have. It's very important that as an investor, you know that you can be aware of it. It's hard to completely eradicate any potential biases, but it's important that you know that they exist. So let's dive into a couple pitfalls, and I want to really kind of dive into them in a more deep structure. So first, timing the market. So market timing is one of the most common that we see. Investors really do believe that they can get in and out of markets. It's something that we see quite a bit. It's very common. So we do want to spend a little bit of time on that. Not understanding risk and risk tolerance. So too many investors just either buy all equities or they're extremely conservative. They don't really think about risk tolerance in the way that they should. So the way that we like to look at it is your ability and your willingness to take risk. So your ability is really the quantitative side. Your financial plan. How old are you? What does your plan look like? Do you need cash flows? Do you need potential growth over time? Things like that. That is your ability to take risk. The other side of it is your willingness to take risk. So how do you feel about taking risk? What happens if markets fall 20%? Much more emotional, much more qualitative. That's how investors should think about it. Many investors don't. They either have too high, too low, or they don't understand why they're allocated the way that they are. Forgetting that past performance does not equal future results. Too many people make decisions based purely upon past performance without understanding why that performance existed. So we're going to spend a little bit of time there. Ignoring taxes. Investors who are in high tax brackets, who have accounts that are taxed annually, should certainly be cognizant of taxes. Understand how they will affect your portfolio. Understand what your after-tax return is. It's something that most investors don't take a look at, but that's another pitfall that most investors have. Treating accumulation the same way you treat decumulation. So a 30-year-old investor is focused on accumulation. They need to accumulate assets for retirement. They have a 30-year, 35, 40-year time horizon. A 65-year-old investor who is entering retirement is now going to be decumulating their assets. They're going to be pulling down and withdrawing on those assets. They need to be handled differently. They need to be approached differently. Too many investors keep their same allocation for their entire lives. That needs to change, and that should not be the case. Not diversifying. It's in our name. We believe in diversification. Too many investors will buy a single stock or two stocks because they performed well. See a previous bias, but concentrating a portfolio is taking unnecessary risk. It's just not something investors should do, whether you're a risk-averse, very conservative investor, or you're somebody who is willing to take risk. Over concentrating your portfolio is just bad investing. And then lastly, letting your emotions affect portfolio decisions. Selling after the market falls 20%, probably the worst time to sell. Going more aggressive after markets have appreciated substantially over the course of time. That's just bad portfolio decision making and something we see as a common pitfall. So those are just 7. I want to focus on 3. So let's start with market timing. Look, I understand that selling when the market gets high and then buying in at the bottom sounds like a great philosophy, right? You buy low, you sell high. Too many investors, though, get what we would call too cute with this idea. They believe that they can time the market on its high and then get back in at its low. And what you find that they do is they wait too long to get back in, or they wait too long to get out. And really, it's just a very, very difficult endeavor to go through. So we have to think about this through two different lenses. One is you have to be right twice. So you have to not only be right on the top, right? So when the market gets to its top, you have to be right then. You have to be right on the bottom. And usually both of those decisions require you to go against public opinion. If you were to sell today, you'd be going against public opinion that things are very optimistic, market sentiment's pretty high, the economy is recovering. March 23rd, 2020 would have been a great time to buy in hindsight, except market headlines were horrendous. No one knew what really the future held. The Fed had just stepped in. So you have to be right twice, and then you have to do it again, and then again. And in theory, if you don't buy back in at a lower price than you sold, you would have just been better off staying pat, staying true to what you were doing. So to us, holding to a long-term investment philosophy and making tactical changes, right? Changes that are opportunistic, where maybe you buy asset classes that are cheaper. Maybe you adjust your risk tolerance a little bit over time to take advantage of things. But going from all stocks to all cash, trying to time the market is a very difficult endeavor. What you find is that the composition of stock market returns over time is made up, especially on the accumulation side, of just a few returns. So the top 10, 20, 30 days within the markets are some of the best days, right? They are the best days, obviously. So we have to think about it that if you miss those days, you are substantially cutting out your potential return. And what you find is that those best days often happen within days or weeks of the worst days. So it's very difficult to do so. So our philosophy here is to remain long-term focused. We're focused on our risk tolerance and then make opportunistic changes. So buy into areas that maybe are cheap, that have been beaten down. Maybe adjust our risk tolerance over time if maybe we need to get more conservative or we see an opportunity there. But this idea of completely getting in or out of the market is a very difficult endeavor. The next pitfall would really be past performance does not equal future results. If you've ever seen sales literature, this is a disclosure that is literally on every single piece of sales literature. The reason is too many investors, and on the flip side, too many investment professionals completely position past performance as a reason to invest in the future. Markets are forward-looking. They don't necessarily care what happened the last 5, 10 years. And this can be from an asset class or an investment selection perspective. So just because U.S. large cap growth or U.S. technology performed well over the last decade does not mean it's going to continue to do that in the future. Oftentimes what you realize is that the future may be a completely different story, at least from an expectation standpoint, because now you are buying an asset class at all-time highs. Another great example is many investors buy an investment security, whether it be a mutual fund, an ETF, a certain manager, based purely on past performance, without really understanding why that performance took place. Morningstar has plenty of data that research has been done that shows a 5-star manager. So for example, Morningstar rates a lot of managers on 1 to 5 stars. And what they did was they looked to see over the course of 5 years, where do these 5-star managers land for the next 5 years? And what you find is really about 20% end up continuing to be 5-star investors. Okay, 1 out of 5. A quarter of them don't exist 5 years later. So based purely on past performance, that was a very potentially bad decision. On the flip side, if we look at 5-star managers today and said, where were they 5 years ago? A third of them didn't exist. Only about 20% again were actually 5-star managers. So our philosophy and our approach, whenever we're making security decisions, picking a manager or an ETF, is to look deeper, to understand what's the source of their return. What kind of risk are they taking? What's the asset class look like? What do their peers look like? What is the company, the parent company? What is the team structure? All of these things, both quantitatively and qualitatively, are important to understand what you're buying and can it persist in the future. Past performance does not equal future results. You have to always be forward-looking. You can use past performance, and that is real data that we can use, but it cannot be the sole use of our data to extrapolate our future decision. And then lastly, I want to discuss accumulation versus decumulation. This is something we talk about a lot today because a lot of our clients have either entered, are about to enter, or are retired. The way you make portfolio decisions at 30 years old should be different than what you do at 65 and 70 years old when you're starting to withdraw assets. They should just be handled differently. And what we find is that too many investors go by simple asset allocation. They're 60-40 stocks to bonds, maybe over their entire lives. Investors need to understand that when you go into a decumulation phase, you have a couple risks that you need to be quite fearful of. And not necessarily fearful, but be cognizant of and address. Longevity risk. If we have a husband and wife, or just really a couple, 65 years old, there is a 49% probability that at least one of them lives to 90. If you are withdrawing on your assets, that is a long time, right? That is 25 years now that you must make your assets last for. And you need to make sure that they can last for inflation. So why would you treat your portfolio the same way that you did at 30 years old as you're entering retirement and now this is a challenge? Additionally, we always say, even though markets go up and down, you don't really lose money until you sell when markets are down. So if you sell when markets are down, yes, you've locked in a loss. Well, as you enter retirement, if you are incorrectly allocated, if you are 100% stocked and markets fall 20%, and now you need to withdraw money, you must sell at that point in time. You are locking in losses. There's also periods of time where we see markets go from their high, they drop down, and it takes them several years to recover. So in that instance, we would like to have other areas to pull from. So this is important when you think about allocating your portfolio at 30 years old versus when you enter retirement and you need withdrawals. We take the approach of what we call spend and replenish. This is our approach. We take it from the standpoint of having a more growth-oriented bucket and a more stable bucket, and having an approach where we pull our withdrawals in the short term from a more stable bucket, and we use our growth assets to eventually replenish, right? To send money to the stable bucket to fund future cash flows. It's a way that we can give our stock markets plenty of time to grow and recover if there's a pullback, and that we know that your short-term needs are met from an income standpoint. But the moral of the story is people entering retirement have longevity risk, they have market risk, they have just different risks than you do as a younger investor, and your portfolios should be treated appropriately. So accumulation versus decumulation, they cannot be treated the same. We see this too often. We approach it a little bit differently. I should say a lot of bit differently. And that's the way investors should think about it. So really, in summary, market timing, very, very difficult. It requires being correct twice. You must buy back in at a lower price. It's emotionally very difficult to do. And what we find is that the best days in the market are occurring very closely to the worst days in the market. And if you miss those days, it can be very detrimental to your long-term performance. Additionally, past performance does not equal future results. Have a philosophy, have a process, and have a very thorough process for picking the securities, picking the type of asset allocation you have. Don't just select something that had performed well in the past without understanding why it did and asking yourself, can it persist in the future? And if it can, why? And then lastly, don't treat your portfolios the same during your accumulation years as your decumulation years. Treat them differently, allocate differently, think about them differently. You'll be better off for doing so. You'll give yourself less headaches when it comes time to market volatility, and you'll make sure that the longevity risk really kind of goes to the wayside, as we know that pensions and Social Security is still there, but at the end of the day, you can't just solely rely on Social Security. So we need to make our portfolio assets supplement our income and last through our retirement. So I hope you found that valuable. I always enjoy talking about the pitfalls of investing because it brings back a more self-aware approach to understanding what potential pitfalls we may come across. But if you have any questions, you can always reach out to us. We're always here. We appreciate your business. We appreciate the trust that you have put in us. If you have any questions, once again, reach on out. But my name is Mike Horwath. I am the Chief Investment Officer here at Diversified. Thank you for stopping by. Stay wealthy, stay healthy, stay happy. Take care.